All right, this is an exciting earnings season. I mean, there's a lot of stocks going up and a lot of stocks going down by a lot. And it feels like the market is sort of petering out in terms of not so much of a rocket to the top, shoot the moon kind of trend that we've seen in the past. Let's get going here. All right, we're covering a bunch of stocks today. We got a lot on the list today. I added a few more since we sent out the emails inviting everybody because I just think there's some interesting stuff to talk about here. A lot of our danger zone stocks, like some of these guys are blowing up. I figure it's worth talking about because the thesis has been really very straightforward for a long time. And it's sort of, well, chicken's coming home to roost a bit. And I think that's an important takeaway. Disclosures and disclaimers. We are not investment advisors. We do not intend to be investment advisors. We are providers of information and nothing else. Speak up in the chat, especially if you're first time. We're looking for people who haven't been around before, and we want to make sure that you are properly welcomed. You have all the questions you want to get answered. We get to them. And then also don't hesitate to send me questions or suggest stocks that we can go over from your portfolio. Put those into the chat, and if we've got time at the end, I will be happy to touch on those and review those at the end. So let's talk about some of the headlines. Stock market seems a little shaky these days, up and down, not just up all the time. I mean, we had a July for the record books. I mean, that was like one of the least volatile Julys of all time. And looks like August is not going to be quite the same. It's been rough. Today was good, but we definitely saw yesterday give back a lot of gains. The ISM services survey, weaker than expected. We did see Palantir blow it out. Super microcomputer blows up again. I've got some good info on that. We were warning about super micro a year ago. Well, 11 months ago, almost to the day. A lot of Wall Street upgrades, into a bull market. That's sort of one of the last signs is like, oh, everyone just capitulates into bullishness. That's a Wall Street trademark. And then yeah, Snap is snapping. It's a business model that we point out is flawed for a long time. And so I think it's kind of just a matter of time before the thing potentially breaks down. For those of you who do not know us, I think it's very important to understand that New Constructs is different. After years on Wall Street, I saw all the tricks that they pull, the misinformation, and decided to build something better. A firm that gets people the truth about profitability and valuation, and to build technology so that I could do that with scale. One version of the truth across all stocks, ETFs, and mutual funds. Can't do that with a team of 20 different analysts. And each analyst has got a super ego about their sector and their expertise, and they got to do things their special way because that's how they get paid. That's the Wall Street model. That's part of the Wall Street model. The other part of the Wall Street model is that they don't get paid as analysts. They don't get paid if they don't do what the bankers say. Couldn't have that either. So we have a centralized system for machines to do all the analysis in a very consistent way, apples to apples. And just in case you want to know how well that machine works, let's take a look at the stock picking track record. Been ranked number one on some zero for 49 or 50 straight months. Our work has been vetted and validated by prestigious institutions like Harvard Business School, MIT Sloan, Ernst & Young, the Journal of Financial Economics. Name another research firm that can make the same claim, and I'll give you a free report of your choice. And then look, here's the cherry on top. Performance of our indexes. We have three of them with Bloomberg. This is the Very Attractive Stocks Index. All it does is track the very attractive stocks. It's a good thing. Very attractive stocks do very well. Outperformed by 0.5% in the first half, outperformed by 77% in the last 5 years. The Bloomberg New Constructs 500, that's just an enhanced S&P 500. By enhanced, I mean instead of weighting stocks based on market cap, you weight stocks based on core earnings. How's that? How about that? Why don't we weight the stocks based on their underlying fundamentals, just not on how popular they are? Well, that outperforms in the first half of this year and by 31% over the last 5 years. And then how about the Core Earnings Leaders Index? This is the fund or ETF based entirely on core earnings. It only picks the stocks that have the strongest core earnings out of the top 1,000 stocks in the market. The Bloomberg 1,000 out of the top 1,000 stocks as ranked by Bloomberg. It beat the S&P 500 by 7% in the first half, by 48% over the last 5 years. Doesn't get any better than that, folks. Now, these indexes are managed by Bloomberg. They run it all. It's live traded. You can look them up. If you want a sample, just want me to show you, just put in the chat. I can take you to the website. But they're not available for purchase yet. But our research is. It's good to have research that's backed by proven performance and vetted by the most prestigious institutions. It's not a bad thing, especially when you consider the fact that Wall Street ratings are like 96% positive. 96% of all stocks are buy and hold. And that's something I want to make sure I'm clear on. It's because Wall Street analysts' paychecks depend on you buying stocks. They make no profit from their research. It's all in the trading or in the underwriting, or that means in the issuance of debt and equity. You have to buy the securities from companies because Wall Street makes money selling them. Is it a conflict? Yes, it's an incredible conflict. 57% of all stocks get a buy rating. Can we have an efficient market if 57% of the stocks are buy? No, doesn't make any sense, right? But it's been this case for a long time. All right, I'm going to skip over this because we've talked about it a bunch. Why don't we just jump in to our analysis here? If you have any questions, let me know. Here's what I was talking about in terms of the website for the core earnings leaders index. You can see here year to date up 13%, while the market's up about 8, so almost a double. 5 years, you can see beating by like 35, 40%, 44%. This is the latest as of August. What is that as? August 1st? Why would it be more recent? This is August 6th. Anyway, you get the idea. Proof is a performance, my friends. All right, let's talk about the stocks we want to cover today. We are not doing Pfizer. That's going to be tomorrow. So let's go in order of market cap here and make this more fun. Palantir, $409 billion market cap. Stock went on a run. We like the business. It's good business, making money, but the valuation is very expensive. And interesting here, you got a negative 24 price to economic book value here. What's going on? It must have a lot of debt. Oh, I know what it is. Huge liability related to options outstanding. 25 billion. So we're talking about a market cap of 409 billion. 25 billion of that is actually promised right here. You see this numbers right here. 25 billion of that is actually promised to, let me see if I can get a nice way to highlight stuff. No, doesn't look like it. 25 billion here. Oh, goodness. 25 billion of options liabilities there. Sorry, I was trying to do some fancy markup stuff with the Zoom tool. It wasn't quite working. But you see that. That's a big number. That wipes out the value of, they got a positive NOPAT, but the economic book value is a negative, right? What does the economic book value negative mean? Well, let's first of all look at economic earnings per share and accounting earnings per share trending in the right direction. Number of shares going up, kind of not surprising. I mean, my stock's going. If my stock was at a price that high, I'd probably want to raise capital. It's such a good deal. Return on invested capital getting better. NOPAT margin, capital turns, all that getting better. Free cash flow, about break even. About break even. And then the economic book value. Wow, you can see the economic book value was positive or negative at all times except for 2023, briefly positive, but it's basically next to nothing. Yet you see the stock price just. So that's, the difference between these two lines is all future profit growth. So you're seeing a lot of future profit growth priced in. So Palantir, yeah, I know they had a big beat. It's really expensive, folks. Really expensive. All right, AMD. AMD didn't have such a good beat, did it? Let's go here. Let's go take a look at it. AMD's earnings weren't so good. It's down a lot. Let's see, down, yeah, 11%. Earnings miss. Boom, getting crushed. Why? Whoops. AMD. Why? It's super expensive. Not a great business. All right. If this is going to miss, it's going to get crushed. That's just the danger of owning an unattractive stock. It's as simple as that. Super expensive here, 14.5 price to economic book value. You see the returns on capital are worse. At least with Palantir, you got some profitability. But I would honestly say Palantir is just as risky because of the valuation is just so high. It's just so high. Now, it's better that the profitability here, we got green. So, there's sort of a little more plausible they could grow in to the valuation in terms of profits. But, when the expectations are that high, that seems unlikely. Uber. Oh, so similar situation. Green here, red here. It's expensive stock, folks. They're priced for a lot of market share, a lot of market share gains. No question about that. And I just don't know. I just don't know how profitable Uber can be long term. Like I don't really think there are a lot of great margins in that business. I really don't, whether it's Eats or whatever. The stock's kind of flat. So despite the fact that I think they had a nice beat, big buyback plan, pretty positive. You don't see the stock doing much because it's all the good news is priced in. Let's see. See accounting earnings looking a lot better than economic earnings. Number of shares going up. I'm telling you, not a good sign. Insiders are just trying to cash in, cash out. Return on capital doing better. Margins doing better. Let's see. What do we got? Free cash flow. Yeah, it's gotten positive here recently, and then but negative again. Yeah, I think long term, like they can put out a lot of specials and maybe squeeze some profits out of a business. But I mean, like, look, it's the taxi business. They start charging too much. I'm just going to go to Lyft or whatever local driver I can go to. College kids now have like a bus thing that somebody started. I think that Michael Dell started, right? So it's they can just all go places together and they don't take an Uber or Lyft, and they're like super cheap. I know other cities have different rideshare programs. I just don't know if long-term profits are there, especially when you're looking at a lot of expectations, right? Economic book value per share just now getting positive, at around 15 bucks and it's trading at 90, 89. What's a fair value? Probably 30. It needs more than 100 years of profit growth to justify the current stock price, assuming, a decent amount of long-term profit growth and or revenue growth in general, and then really high profitability. So, yeah, if we think about Uber, Shopify, whew, it's another super expensive stock in a business that I don't think is a lot of differentiation. I think we've talked about this one quite a bit. It's an expensive stock. It's in our focus list short, strong miss. How do they do here? This is one I haven't seen any headlines on. Wow, did extremely well. Tariff hit did not materialize. Revenue beat. Forecast quarterly revenue above estimates and resilient demand. Looking good. Looking really good. I would beware. I would beware. I'm seeing a strong miss here. So, it doesn't look too bad in terms of core earnings, but as a percent, earnings distortion as a percent of assets, that's super high. That's a big number. So even though I guess it's you get the problem is the scale here. You've got a big variation in gap earnings. And so this earnings distortion number looks kind of muted. The difference looks muted. But this is interesting. I'm wondering what we're going to see this quarter. I'm betting when we get the new information in, we should be getting it any day now. Next expected filing, 6K. I'm betting when we get that in, we're going to see potentially an increase in divergence. That's probably what's going to happen here. So be careful with Shopify. Arista Networks, another neutral rated. Same story. Arista, very good looking company, 109% return on capital. Love that. Expensive valuation. If this is sounding repetitive, folks, it's because it is. You don't need to spin up a new special narrative for these stocks every time, right? There's one version of the truth, and you're focusing on the economics relative to the valuation. It's not that complicated. As my kids like to say, it's not that deep. It's not that deep. Either the valuation is appropriate for the stock or for the underlying business, or it's not. And appropriate is subjective, right? When we are quantifying future cash flows, we've put a system up to measure relative to other companies whether or not those are really high expectations. And when they're high, it's bad. And our stock rating system has done pretty well, right? You saw the very attractive stocks that significantly outperformed, so it's not terrible, not terrible. But Arista Networks, strong numbers, claw momentum, guidance hike, so you got to beat, and we had a beat predicted. So look, the earnings distortion score, it's a short-term metric, right? It's a beat or miss, but it doesn't take away from the fact that this is extremely expensive stock. right? So I'm guessing we're going to see core earnings are above accounting earnings. So yeah, we expect them to beat. We expect them to beat, which means you might see a nice little short-term pop, but long-term, the stock we think is too risky, right? You want to see green across the board. That's what you deserve. MercadoLibre, same thing. Wow, it's suspended rating because we're probably going through the 10Q right now. So we'll need to check in again tomorrow to see how this looks, but I'm guessing the valuation numbers aren't going to change much. Maybe the profitability gets worse. Yeah, you're down and then down today in an up market, pretty strong. That's because again, you got an expensive valuation. When you're looking at, here, you're seeing red out here on the right, you sort of got nowhere to go but down, unless you're playing on FOMO, MOMO, all that kind of stuff. Red over here means it's a speculative play. Maybe you like speculation. Super micro, suspended, weak internal controls. Who remembers when we first identified weak internal controls in super micro? August 30th, 2024. What happened a few weeks later? The auditor resigned or announced it was going to resign or they had a problem, then officially resigned in October. That's bad news, folks. That's bad news, right? It takes a lot for an auditor to resign because they lose a client and they probably lose a lot of other clients or potential clients because nobody wants to hire an auditor that's going to resign on them. Remember back during the tech bubble, they busted all these audit firms that were conflicted because they wanted to keep their clients in their consulting business and they like were fudging the numbers for Enron and WorldCom and another Health South, maybe another like hospital or healthcare company. Yeah, I mean, come on, folks, who we kidding? There's conflicts there. So like these guys don't want to have to resign. It looks bad, makes them look bad, makes everybody look bad. So when they resign, it's bad. And what happened to Supermicro? Oh wait, they had a big miss. And what's it down? 24% the last couple of days. Yeah. Be careful with this one, folks. Be careful. You got red over here. Anytime you got red over here, just watch out. Especially if you got false positive in economic earnings, right? Because accounting earnings are looking better than economic earnings. That's a sign of a miss for sure. Core earnings versus accounting earnings, not that big a difference. But when the underlying business might be weak because they've been trying to juice their own internal accounting to make it look better than it is, watch out. Simple as that. Watch out. When you see weak internal controls, that's a sign to run. Don't walk, run from stocks where there's weak internal controls. A lot of red here. I don't know what to say, except that the stock, equity residential, not looking so good. I think it's been a hot stock. No, not really necessarily. And apartments in a lot of big cities, sixth largest owner of apartments in the United States. Big market cap company, not doing so well. Down 11.6%. Yeah, look, nothing really redeeming about this. Low profitability business. You've got, economic earnings really divergent here. I mean, I'm kind of surprised. Well, both are going down, so I guess that's okay. Number of shares flat, but yeah, you got a big divergence between economic earnings and accounting earnings. That's never a good sign. Never a good sign. Tyson Foods. We just had to drop this from our focus list or our long list, mainly because I think these guys are going to be hurting when it comes to beef prices. It's going to kill their business. It's going to really hurt their business. They're just going to go way up. We're going to see demand go way down. So, but they had a good one. Higher beef prices, power a beat and raise. Yeah, I guess it's a good thing. I think it potentially may mean that beef prices are going to potentially hit demand. And so people just aren't going to buy as enough beef. I don't know about you guys, but like, yeah, like my beef purchasing has for sure shifted away from what I used to love to buy, strip steaks, and now we're more on the flank steaks and even doing some roast because I was used to buying it for $9.99 a pound at Costco. Now it's like 15, $16 a pound. It's a big difference. We're buying a lot. I got like three boys. Like we crush a whole one of those 4 packs of steaks from Costco, one meal. And sometimes that's not enough. So yeah, well, good for Tyson. We're not, we don't, we like, I mean, I was a fan. This was on our focus list. So Maybe we had the thesis wrong. Maybe they just make so much money on higher beef prices. I don't know. I think it long term is more damage than good. Year to date, it's not been such a great stock, but good day today. Not looking so good here either. So Snap. Oh yeah. I had to add this to the list. I mean, we've been warning people about this stock for so long. And it's because, you know, I mean, look, negative, 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 100 years. Like, oh, I mean, I don't know if it was ever a zombie stock. Yeah, it was a zombie stock. They must have cut their burn. But look, you can see you're selling shares to fund the business. Return on invested capital, way below the cost of capital. These guys can't make money. Negative margins, negative margins, negative margins for years, for years. An evaluation that implies huge amount of future profit growth. Huge profit growth. They've never had profits, but the valuation gives them credit for huge profits. I just think this is dangerous, and I think they're competitively boxed in. Like, I mean, it's a kiddie product, and then kids grow out of it, and who knows when the next app's going to come along. I'll admit my kids use it a lot. I mean, I don't like it so much. I put time limits. I don't know if you guys know, you get can put, if you got an iPhone, I'm sure Android is the same thing. You can significantly and directly control how much time they get on their phones. And I do that a lot for my youngest, for sure. The boys, when they get over 18, I'm kind of like, all right, you're on your own. But yeah, it's a tough business. Negative, negative, free cash flow, negative, negative, negative. Yeah, these guys could be headed back to the zombie stock list. I think they cut their expenses pretty good, so maybe the free cash flow, or they sold some stock and raised some debt. Let's see here. See any debt increases? Yeah, a couple years ago, but 4 billion in debt. Option valuation is not too much of a big deal. Tough business. Tough business. Look at this. Negative, negative, negative. Right? Bad. Bad, bad. Bad, bad. Bad stock. Bad business. Never made any money. I don't know that it ever will. Rivian, similar situation. Focus list short. We've warned people about this for a long time. The investor relations people called me and said, "Hey, talk about how we're going to get more profitable." I'm like, "Okay, good. I'm glad you're going to get more profitable." But the valuation implied or the profitability implied by your stock price is just way too much. Let me give you an example here. We're talking about the improvements in revenue and profits that got to happen for Snap as an example. Let's take the optimistic scenario. We'll just put it in here. That's 18% compounded growth in revenue and a huge increase in your average return on invested capital spread versus WACC, right? So we can go and look at the implied increase in revenue and profits. There it is. So you're going from kind of close to zero up to 66 billion, baby. Right? Where are we at revenue right now? That's 5.5 billion. What do they got to do for profits to justify the price? Hockey stick, baby. So negative, 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 really negative, negative, whew, turning positive and going all the way up to 5.3 billion. That's what's priced in. That's what's priced in. So to own the stock now, you got to believe they're going to do better than that. So the market will price in even better future profits. Return on invested capital. Negative, 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 up to 90%. That's like better than Facebook. Is Snap going to have a better return on invested capital than Facebook while also growing revenue compounded annually at 18% for 15 years? Come on. All right. I don't think anybody can make a straight faced argument that that makes sense. Let's do the same thing for Rivian. I don't have another scenario for Rivian. Maybe we'll put another scenario in here. Let's give them margins that go up. Let's try 10%. By the way, their margins have been negative 90 forever. Okay. So we're giving them a huge increase in margins. We'll save that off. We'll see if that makes the model look any better. In the meantime, let's maybe knock out another stock here. HIMS. My buddy Herb Greenberg doesn't like HIMS. Look, we just got a new filing in. Profitability looks good. Valuation. It's all priced in, folks. It's all priced in. How do they do in their most recent report? We had that strong miss. Looks like, oof, oof, oof. Ugh, excuse me, that's a gut punch. Big earnings miss. Well, Don't say we didn't warn you. Strong miss. Core earnings. Look at that. Counting earnings going up faster. Bam. Bad sign. So we were helping you out on HIMS if you were paying attention. Okay, let's look and see if this optimistic. Okay, so we jacked up the margin to 10%, not good enough. Why don't we try adding an optimistic scenario here? I want to give them like 20% margins. This is our reverse discounted cash flow modeling tool. So this is where we figure out like what kind of future performance is required to justify the price. And so I think it's a really cool tool. I think it's an amazing tool. All right, here we go. Rivian, optimistic. All right, 3 years. Okay, so what does that look like in terms of, you can see, revenue goes from 4 or 5 billion up to 11.7 billion. Profits, free cash flow, we don't need free cash flow. Free cash flow goes from negative 3 billion to positive 2 billion. No pat. Goes from very negative to positive 2 billion. So yeah, it's giving the credit for the business to grow and become very profitable. Grow at 33% while also dramatically improving its margins. So what does that mean? That means they grow faster than the market. We all know the EV market is actually in decline. So they're taking crazy market share while charging way more. Does that make sense? You think they're going to do that? All of a sudden, people are going to be like, oh, you know what? I could have paid, I don't know how much a Rivian costs, 70 grand. But if you charge 140,000, I'll go buy more. What do you think? Unlikely. Watch out for Rivian. Open Door Technologies added this because it's been on, actually it was on our danger zone focus list short as well as zombie stock list. And we took it off because I think it started trading under $1. And that's kind of when we close out the zombie stocks. It's come back some here recently. Let's see. Yeah, see, we closed it out around here. Meme stock, boop, boop. What happened? What happened to your meme stock? Watch out. Watch out. Down 25% today. 200% for the year, 18% year to date. Watch out. This is one to be careful of. If we were more trading oriented, we probably would have like come back and been like, yeah, let's put this back on the list. But we kind of don't mess with meme stocks. We don't take them seriously. All right, I got time for 2 requests. First one that came in here, AMCR, and then UNH. All right, let's take a look. Where's AMCR in the market cap stack here? Amcor. Neutral rating. Yeah, it's a meh stock. I believe that the strategy for investing should be in the fat tails. The stocks that are underpriced and more profitable than you think, buy those. The stocks that are overpriced and less profitable than you think, sell those or short those. That's where to play. I want to play where Mr. Market has it wrong. I want to be a critic of a fortune teller, not try to be a fortune teller. And so with stuff that's neutral, it's like most of the stocks in the market are going to be neutral because the market is semi-efficient. So, right, you don't play in those. And that's what you got with Amcor. So it's nothing really strong either way. But if you're going to go out there and try to beat the market, what do you got to do? You got to go against the herd, do things that other people don't do. That means you probably don't mess with the neutral stocks. All right, UNH. This is a tough one. It's cheap, super cheap, right? It's come down a lot. What's it come down this year? Yeah, 50%. But you get some questions about the business model, DOJ probe. Like, I don't, the stock price implies a permanent 30% decline in profits. Maybe that's the way to go. You can see here the analyst notes. We got a lot of detail. We cover the stuff. We suspend things when they look nutty. It's a cool part of this is all this, by the way, is our professional membership. All that I'm showing you is part of our professional membership. So a lot here, including a credit rating. Still looks pretty good. Yeah, I'm not, again, neutral. And then you've got overhang of regulatory and legal risk. I was like, I wouldn't mess with it. Okay. Thanks, everybody, today. Enjoy being with you. If no more questions, we will sign off, and I will see you on Friday for another earnings watch.